All right, welcome back, folks, to another Rev Real Estate Live. My name is Dallin Schultz. I'm the president at Rev Equity Group, and we do these free weekly webinars to educate people in the apartment investing space. So we get not too deep into the weeds on these webinars, but it's really to introduce ideas, concepts, and help you become a little bit more educated moving forward. So appreciate you tuning in today. If you do have questions throughout this, please throw it in the chat box. I have a few people on my team here that will help monitor that. And I haven't done this before. I don't know why, but let me introduce them real quick. So we have Jim Hodges. He's our director of operations at Rev Equity Group. And then we have Paul Karchner, who's our project and systems manager, make sure everything is moving smoothly. And then we have Hillary, who's our executive assistant, that's doing everything on the back end for these webinars. And she's going live on multiple platforms. And she probably looks like a mad computer scientist in the background during all of this. So appreciate her being on. And with that being said, yeah, we do go live on multiple platforms and we do record these webinars and we upload them to YouTube. So if you're not able to tune in one week, it's okay. You could come back in and catch it another time. And we send those links out every single week in our follow-up email. So excited to talk about today's topic. So this one will, truthfully, will probably be 20, 30 minutes today. It's not a super long webinar, but something that I really want to touch on because when you look and when people are investing and they're in the world of stocks, bonds, mutual funds, real estate, it's very easy to get caught and focused on the average annual return, whether that's 10%, 12%. When you ask somebody what they made in the stock market last year, they're going to say, I made 16%. And what they're talking about is that average annual return. So there's a lot of benefits of investing in real estate that aren't often talked about. And so what I wanted to touch on today was 4 ways you essentially earn in one real estate deal. So we're going to go ahead and jump into that. Okay. So we've got a beautiful apartment building. Everyone see this okay? I hope there's not too much of a glare. You can just nod your head, give me a thumbs up. So, okay, excellent. So we've got an apartment deal here. So with real estate, let's just say that we purchased this building for $1 million. And before I get further into this, I want to preface that all the real estate that we purchase at Rev and what you'll typically see across the board is people using leverage. They're using bank financing for a good portion of that property. And that's what makes real estate investing so powerful. Now, I'm all for business debt as long as it's conservatively used and projected and analyzed. So what I'm going to show you is the power of leveraging real estate, using debt to purchase real estate, and how it actually works out in your favor. So let's say you have an apartment building here, $1 million. Typically, you could expect 60 to 75% of that cost being covered by a bank. Now, last couple of years, they were going up to 80, 85%, which I wouldn't recommend ever, because when you get over leveraged in real estate and the market takes a dip or it shifts, that's where people are getting themselves into trouble. In fact, we had a conversation with an operator yesterday. Jim and I visited with him, the big operator here in Phoenix, and he's across the board. You're seeing operators right now getting themselves into trouble because what happened was they got into deals 1-2 years ago. They leveraged 85%. They didn't have a lot of capital reserves on hand. And now they have these loans coming due and they don't have enough equity in the property to refinance out of it. And so they're having to recapitalize and bring a lot of money back in. So even if the bank's allowing you to take 80, 85%, I would discourage that because it's better practice. It's more conservative to get in on the lower end. Anyways, so let's say you got this deal, $1 million. I'm keeping it at $1 million. It's simple. What I want you to take away from this this webinar today is the basic principles and understanding. Numbers are going to change. Numbers are going to be variable. Deals are going to be different. I want you to walk away with the idea and the concepts that I'm trying to convey to you. So you got a $1 million property. Let's say you put down 200. That green is not coming up good. $250,000 is what you put down. So the first thing I want to talk about is the appreciation. Real estate appreciates. It goes up in value. Now, according to the Federal Housing Financing Agency, since 1991, just some little fun facts for you. 1991, homes have appreciated on average 4.3% a year. So that's just over 30 years and an average of 4.3%. Now, since 2012, the average has been 7.7%. So what I do want to point out is that these are for home values. It can be very difficult getting into trying to determine the average appreciation for apartments because there are so many variables that go into it. You have forced appreciation, you have value add, you have core, you have all these factors going in. So for a good rule of thumb, what I like to do is just go off of the average annual home appreciation, which if we look at these 4.3, 7.7, let's just be conservative and say 4%. So 4% a year. So what that actually works out to be is essentially a $40,000 increase. Now, you bought the building for $1 million, but you didn't put $1 million into it. So if you take that 40,000, divide it by what you actually put in, which is the 250, that works out to be right around a 16% return in that first year, just on the appreciation of this property. So the next thing I wanted to, so this was appreciation. The other one I wanted to talk about was cash flow. This is everybody's favorite. This is why a lot of people get into the real estate game, is because of the cash flow. The cash flow are the monthly payments that come into you as an investor. So using our $1 million example here, realistically in Phoenix, $1 million will probably buy you a fourplex, which isn't too impressive. But if you're looking at Texas and other markets, you can probably get a little bit more units for that money. So every market's going to be a little bit different, but for this example, let's say that this $1 million purchases you a 6-unit property. A good general rule of thumb for cash flow when you're financing real estate is $200 to $250 per door per month. If you can cash flow that per month, then it's a decent deal. So that's a good general rule of thumb. Obviously, some years might be lower, especially if there's heavy value add, or if you're in a very high cash flow market, Midwest, for example, you might be cash flowing a little bit more. But general rule of thumb, $250 per unit per month. So on an annual basis, you're looking at $18,000. Now, again, you divide that into what you put into the deal. You got your 250. Now you're looking at, let me go red there. Now you're looking at around a 7% return. And on large multifamily assets right now, investments, you could expect and anticipate around average annual return on the cash flow 5 to 7%. So this is right in that range there. And what a lot of people are banking on now is the appreciation. So when you sell that asset and that appreciation, that equity flows back in, that's where investors are getting up into these double-digit returns. So most people stop here. Most people look at the appreciation, they look at the cash flow, they can measure it, they can see it, it makes sense, and they stop there. So one thing that I want to get into next is the two other aspects of real estate investing that a lot of people overlook. We got depreciation and amortization. We have talked heavily about depreciation, especially last week's webinar. We had a guest speaker talking about cost segregation studies. So if you missed that webinar, I highly, highly, highly recommend you go back and watch it. Justin Jensen, who's on our call with us today as well, who's a CPA, a real estate focused CPA, also did a webinar with us talking about depreciation and the tax benefits. This is something that I personally feel like is not taught or explained enough to people looking to get involved in real estate investing. So with the depreciation, and again, I'm going to be very simple on a lot of these topics because we get more into depth on these individually on other webinars. So I'm gonna just introduce the ideas to you. So the depreciation, that is a loss that the IRS allows you to take because of the wear and tear of the property. And so and Justin, I'm glad you're on because you can verify this for me. A quick rule of thumb, and what I've heard and what I've been told is around 80% of that purchase price can be factored into depreciation. Is that correct?
Yeah, that's a general rule of thumb. It really depends on the location. If you buy a beach house in California, say, you'd be lucky to get 60%. Because primarily the value there is going to be the land, and you can't depreciate the land. But with depreciation expense, we want to allocate as much as we dare to the building, to the structure that is deductible. And 80-20 is a typical rule, 80 to the building, 20% to the land. That's pretty conservative. There's some studies based on the tax valuations, they'll go 90-10. It just depends on so many things, but 80 is always safe.
Excellent. Thanks for clarifying. And he brought up a really good point. You can't depreciate the land. The land there's no wear and tear on the land. It's just there. So the IRS doesn't allow you to depreciate that. They look at the building and everything within the building. So general rule of thumb, 80-20, that's just a simple, quick way to look at this. Now you can really enhance that, in my opinion, by doing a cost segregation study and utilizing bonus depreciation, which we're not going to get into. We talked about that heavily last week, but for this example, we'll take 80% of that $1 million. So now you're looking at 800,000. Now with residential real estate, the IRS allows you to divide that amount up over 27.5 years. If it's commercial, so industrial, retail, office, it's 39 years. So another good reason, tax benefit of getting into residential multifamily real estate, because you can take that 800,000 over 27.5 years versus 39 years. So you can actually capitalize a little bit more on it. So you take your 800,000, divide by 27.5 years, and you're looking at just about $29,000 a year that you can take as a loss. Now, let's just assume you're in the 33% tax bracket. You do that math there. You're roughly gonna save about, or pay, so you're going to save $9,600 in taxes. And so you take that 9,600, divide it again by your 250,000, and you're looking at right around, works out to be about a 4% return on that capital. So this stuff is coming directly into your pocket. This is stuff that's just not going back out to Uncle Sam, right? You get to keep it, you get to reinvest it, and it's less money that you have to pay in taxes. This is the beautiful thing. We purchased this property for $1 million, but you didn't invest $1 million. You invested $250,000, but you still get to depreciate that entire asset. So even if you were to come in with cash at $1 million, this wouldn't change. So you're actually getting more for your money because you're coming in with 250,000 versus the $1 million. Justin, anything else you want to add to this here?
No, man, you're doing great. That's like singing my song. I love it.
Hey, listen, when you have a CPA that nerds out over taxes like Justin does, get with them. Okay, get with them, have a conversation with them, because when you find somebody that's passionate about what they do, you know that they're going to go to bat for you. So that's depreciation. So we have appreciation, cash flow, depreciation. Now let's talk about amortization. So amortization is your principal pay down. When you purchase these assets, it's very common to get into financing where that principal is being paid down year after year. But who's paying that principal? You as the operator, or is it the tenants? So if you have a loan with fixed financing that starts amortizing right away, the math on that typically works out to be around 2 to 4% a year is the ROI on that, because you're not paying down that principal, your tenants are. And so we'll just meet in the middle here and we'll say 3%. So now in one single deal, you're earning in 4 different ways. And what happens is when people look at real estate investing, when they look at stocks, investing in general, this number here is what they're looking at. They're looking at the cash flow and maybe the appreciation as well, which with those two numbers together, you're still looking at around a 23% return on that project. But once you factor in these additional pieces down here, overall, this project is looking at about a 30% ROI because you conservatively leveraged bank financing and you got into residential real estate. You got into an asset class that the IRS favors and provides a lot of benefits for. And not to mention the lending terms on multifamily real estate. It's not uncommon for those to be better than if you were to buy a single family home or be very competitive, because banks love multifamily real estate. They see it as one of the most conservative and recession resistant, not recession proof. Nothing is recession proof, but they really like dumping money into these types of assets. Same thing with life insurance companies. We had a webinar on lending options, and there's a lot of different lending options out there. Insurance companies can be very, very great lenders for these types of assets. So that's the beauty and the 4 ways you can earn in one real estate deal that a lot of people don't realize because they don't factor in the depreciation and the amortization. Now, Justin, I know you're a real estate centered CPA, but how many tax benefits, what types of tax benefits can people get investing in stocks?
Oh, it gets bad. And I'm biased, I admit to you, but if the best you can get is a 15 or 20% rate of return on a long-term gain, you can pay 0 tax with real estate. So why would I go 15 or 20? Plus, we could go all day into this stuff. I love your diagram there, because you're hitting everything that I talk about with clients. I call it the 4 pillars of real estate: cash flow, appreciation, tax benefits, and equity. That's your same 4 squares there. And so we're definitely on the same page. But think about, most people are investing in a 401k and they're saying, well, that's tax deferred, so that's good. And I'll put that in stocks and bonds or an index fund, and they'll grow it that way. But think about what they're losing there. If the best that they can get is a 20% tax deal outside of the IRA, but inside the IRA, one day you're going to pull that money out and you're going to pay your full rate on it anyway. So you're losing it on that. And do you want to retire rich or do you want to retire poor? And what I mean is, if I go into my 401k at a 20 or 25% rate, tax rate, but then when I'm ready to retire, I'm in a 33 or 35% rate of return. That's a deal the IRS will take all day. They'll say, we'll let you pay less tax now because we think you'll pay more taxes later. And I mean, I could go on and on. I'm rambling, but yeah, I love what you're saying. You're just hitting everything.
The point is, look at it this way. Like, let's say you were invested in stocks and you were getting 10% a year, and you were investing in real estate and getting 10% a year. Most people stop right there. They're like, oh yeah, I got 10% of my money. Okay. How much of that are you going to be paying in taxes, especially if you were to cash it out? Are there some short-term gains? Are there some long-term gains? So yeah, you might be earning 10%, but by the time fees are factored in, by the time inflation, right? Inflation right now is what, 9, 8, 9%, 10%, maybe higher. So if you're getting 10% on your money, you're basically breaking even. You're balancing out, right? And then you factor in fees and the tax implications because of this. Just because you're getting a 10% return with stocks doesn't mean you're keeping 10%. Where with real estate, I'm telling you right here, and I think this is why Justin gets so excited about it, the depreciation, this is what sets real estate apart. One of the biggest things that sets real estate apart, in my professional opinion, because it is a paper loss that is given to you. It's a freebie just because you're getting into an asset class and providing a basic human need that people need and require, and that's housing. So when you factor all this together, this is why our team gets excited about multifamily real estate. Now, this doesn't only apply to multifamily real estate. You can experience some of these in single family and in commercial and other types of asset classes. But I wanted to show you what it looks like in a multifamily example, since that's what we focus on. So, and really that's all I had for today. Like I said, today was just going to be a short and sweet, and I wanted you to walk away with basically the 4 pillars, or your ROI matrix, the 4 different ways you can earn in one deal. And that's your appreciation, your cash flow, your depreciation, and your amortization. I will say one caveat to amortization is there's a lot of loans that are interest only. So if someone is doing an interest only loan, you may not be able to capitalize on this as much. So that's a little caveat to that. And with that, that's what I got, folks. Any questions about what we've talked about today?
This is Al. I have one question. Not sure whether it's for you, Dallin, or for maybe Justin, but what's the most tax effective way, I guess, to move money from, say, IRA or mutual fund, whatever, into a real estate investment like this without, taking a hit on the withdrawal or the transfer?
So there's 2 good vehicles for that. And in fact, Beck just went through this with us on one of these most recent deals. So the 2 vehicles that we suggest and recommend the most, and Justin, feel free to chime in. One is the self-directed IRA. So you can transfer, depending on the situation, you can just transfer those funds into a self-directed IRA through a third-party custodian. And what that does is it gives you control to invest that money in alternative investments. That could be real estate, that could be crypto, that could be gold, silver, precious metals. So that's one option, and it's not a cash out, you're just transferring. And so it doesn't trigger any type of capital event or taxable event. So that's one. The other one that's I've seen people do is a solo 401k. A solo 401k. And one of the big things you got to keep an eye out for between a self-directed and a 401k, self-directed, they have a tax that can come in on the back end called your UBIT tax, your unrelated business income tax, that some people aren't even aware of. Now, I know Justin's aware of it because he's a real estate centered CPA. There's other CPAs that may not be aware of it. So people will get into a deal with their self-directed IRA thinking that it's growing tax-free. And the way the IRS looks at that is they're saying, hey, you purchased $1 million asset, but you borrowed $750,000. So that gain that you're going to get on the back end, since you borrowed 3/4 of it, we're going to tax a portion of that. So people will go in with a self-directed IRA thinking that it's growing tax-free, and then they get surprised with this UBIT tax on the back end. That does not apply to solo 401k plans or self-directed retirement plans. So I'd say those are the two best ways to go about that.
Okay.
Justin,
And it
what would
sounds
you like
the
to add to
solo
that?
401k is the better way, generally speaking.
If you can qualify for it.
Well, I don't want to tank your meeting, but I did set one up years ago. I didn't know there was any actual particular qualifications to it. It was really easy to set up.
It usually is.
Oh, okay.
So, Justin, what would you like to add to that?
If I may, if we're talking about real estate, and one of the biggest, and I'm a nerdy tax guy, I admit, but if one of the biggest benefits of investing in real estate is the depreciation and the tax benefits, then and take this for what it's worth, and this could lead to a whole other conversation, but and not to undo what you just said, because I am a fan of certain investments in a self-directed IRA or any other self-directed retirement vehicle, just not real estate. And let me tell you why. Because real estate, because of the depreciation, is a tax shelter. So on your example, you've got $29,000 of depreciation expense. That's a non-cash deduction. That's just the deduction the IRS is going to let you take ratably over 27.5 years. And that's if you don't even accelerate it through cost segregation. So if that property is generating $30,000 in cash, that's cash you put in your pocket tax-free. You're not going to pay any taxes on it because you didn't have to pay for a $30,000 deduction. But if I do that in an IRA, the IRA is also a tax shelter. It was going to grow tax-free anyway, right? And so then you say, well, if it's a traditional IRA, one of these days you're going to pull money out and you're going to pay taxes on money that you would not have paid taxes on had you not put that in, had not had that real estate inside the IRA. So then people say, like what you're getting at, well, but it's a Roth, so it doesn't matter. Like, well, it does matter, because if you put debt depreciate or debt real estate in a Roth IRA, you can get bit by unrelated business taxable income, and you're going to end up paying taxes anyway. So the only rebuttal I hear to real estate in an IRA that I can't argue with is, yeah, I get everything you're saying, but it's still a better rate of return than I would get in the stock market. Like, okay, you got me there. But if you're going to do real estate, and kind of Al, to your point, kind of what you were getting at is, depending on other factors, I actually consult with clients on taking your money out of the retirement account and then I wouldn't take it out until you had somewhere to put it. But so for example, if you were to make a withdrawal right now, you've got the rest of all of this year to find an investment to put that in, that potentially we could do some of the things that Dallin was talking about, where we could shelter that income and you'd pay very little, if any, taxes on it, especially if we can qualify as real estate professional. But even if we can, and you end up paying taxes on it, in 2 to 3 years, you're going to more than break even and you're going to come out ahead. So long story short, and not to tank your meeting down, I'm sorry, I'm just not a fan of real estate inside a retirement account. It's a tax shelter inside a tax shelter. And it's like taking -1 and multiplying it by -1. It has undesired tax consequences that people don't plan for.
And my
Thanks.
caveat to that is working with a CPA like Justin that knows this stuff, right? So you connect with someone.
That's not why I'm attending these meetings, but I really,
But this is it's ironic, Justin, because taxes come up on almost every single webinar that we do, right? In one way or another, because it's such a strong benefit to real estate. So
Yeah.
I appreciate your comments. I truly do. And to his point, Al, this is something that we've done. So there's 1031 exchanges. Most people are familiar with that. It's a like for like exchange. In the real estate space, people will implement this so they don't pay any tax. They defer it, they get into another like kind asset. The past few years, because of the tax benefits, because of this depreciation, we haven't needed to do 1031s. Because 1031s, you're in a tight timeline. You have to identify the deal and you got to get that money working for you right away. For example, we sold a deal back in February or March, and because the depreciation and tax benefits were so strong, we had that entire year to get into another asset large enough to offset that tax we would have paid. So it's a similar concept to what Justin was just sharing with the self-directed IRAs. There's enough tax benefits and depreciation that as long as you have a good tax advisor and CPA counseling you, there's ways that you can likely get around having to do that.
Yeah,
Yeah,
thank you.
Dylan, I wanted to step in here. Hey, Justin, long time no see.
Yeah, all the way since last night.
Yeah, we ran into each other last night. That was pretty funny. And I knew I'd recognize it. After I left, I said, I got on the call this morning. I mean, I said, man, I know I've seen him somewhere, but yeah, I was on these calls. I don't know why I couldn't connect the two last night. It was so many other things going through my head, but yeah, it was fun to catch up there.
Yeah,
So Dallin, I was going to mention that, well, you just mentioned that you can use, instead of doing a 1031, which sometimes when you have multiple partners and a lot of LPs and you're trying to do your 1031, it can be very difficult for you to get everybody on the same board, same page, and then do the 1031. There's ways to do it, but it's a lot involved. If you don't have everybody on board and some people want out, there's some processes you have to go through to meet your 1031 exchange, and it can be quite cumbersome. So doing a cost seg is it drills down to the individual. If you because that's who pays the taxes, right? So you do the cost seg and you buy in the same year, you can really alleviate your taxes. And so if you sell one year and you got a whole big chunk coming in, just buy some things and you can do a cost seg to recover some of that on the same tax return. So there's some advantages of doing that, and it gives you more flexibility as an individual, where the 1031 requires a lot more involvement from other partners and LPs. And not that it can't be done, it can be, but it's difficult when you have people that want out of a deal when you do a 1031. So I don't know if Justin, if that's pretty accurate from what I understand anyway.
oh, you're spot on. You're exactly right.
So that the flexibility that with real estate, and I don't say that stock market or stocks or bonds or mutual funds or things like that are not a good way to go. I know people that have made a lot more than I can imagine in the stock market because they're highly educated. I call it insider trading because they always get the deals I don't get. But they say, well, you get off market deals. I can't get your deals. And I say, so we all have insider trading. But I like real estate because the impact you can see. If you buy stocks, if I buy a stock in Coca-Cola, I have zero influence of what I can do at Coke or Zappos or Amazon. But I can buy a real estate and I can impact the community and then say, you know what, we did that. And just, I don't have to tell anybody. I just know that it was a big difference that I made in a community. And that's what lights my fire. So if you love real estate, it's a good way to get in and plus get tax savings. So I look at it that way as well.
Hey, Bruce,
Absolutely.
yesterday you said you have a brother who's a CPA. Is that Philip?
Yeah. Yep.
I know your brother.
You do.
Yeah, very cool. So there you go. I mean, and everything you said is spot on. I couldn't, I'd have to echo everything you said. There's just ways, if you do it right, you can shelter the income. If you do, you have to time it. With 1031, you have the timeline, yes, but like, for example, and we were just talking with Al, if he makes that withdrawal now, he has for the rest of the year to buy a property before the end of the year, so we can help offset some of that income that you have to recognize from the withdrawal. Same if you sell the property, then you have the rest of the year, or I wouldn't wait to the very end of the year, but you have some time to find property and you're not up against the 180 days like you are with the 1031, and you don't have to deal with partners not wanting to, some want to and some don't, and you have to do a drop and swap. And it's like you said, it's a lot more cumbersome.
Yeah, so Phil, yeah, he's my short brother. He's an inch shorter than me, so he's
Bruce,
only
everyone's
6'.
short. Everyone's
only
shorter than you.
6'6".
Everyone's shorter than you.
No, but he's no, but yeah, it's funny you know him. Yeah, Philip is he's more reserved and quiet and smarter than me. So as far as the other thing about the doing a depreciation or doing a sale, if you sell a property at the end of the calendar year, don't you run into a challenge if you don't buy it till the next year though? Wouldn't you have to pay the taxes? And like if you closed on one in December and then you bought a new one in March, you would have the tax one year and then the benefit the next, but it wouldn't be in the same tax year. So there is a calendar you have to fight with, right? On those.
Correct. No, that's correct. That's why we're looking at early in the year. If you were looking at selling something in December, I would either wait until January or I would do a 1031 exchange. I mean,
Yeah.
but there's
Yeah.
planning. So.
But that's where there's options. That's what's great is there's so many options you can do with real estate. As Dallin said, there's so much you can do to make a difference in your own tax life. Like we heard last night with Steve and Jenny that they're doing well and they're well enough that their spouses don't pay much taxes. So
yeah.
But yeah, good stuff. So thank you for that. Yeah, I just wanted to make sure I was stating, because I've told people that and I thought, well, but I tell them I'm not a CPA, I'm not an attorney. You got to talk to your own counsel, your own advisors, but this is what I understand. So
That's one of the benefits of having Justin on these calls with us these past few weeks, because we could just defer to him immediately because he is a CPA. So appreciate the comments. Al, that was a very long-winded response from multiple of us. Did that answer your question?
Yeah, that was super helpful. And I guess my takeaway was you have to look at like the bigger picture with regard to the tax consequences, end to end, right? And so, yeah, I get it. Thank you.
Absolutely. Great question, though. Appreciate that. Any other questions? Awesome. All right, folks. Well, we'll wrap it up a little bit early today. Nice and short and sweet. Appreciate you all tuning in. Again, we have these every single week. So if you found value in these, invite a friend out, invite someone out. We're really looking to spread this education and get more people involved in this movement, if you will, with real estate, because this is stuff that's not talked about enough. And so that's one of our missions at Rev, is to get this information out there so that we can accelerate people's way to financial freedom in real estate and overall just make apartment investing easy. As you can see, there's a lot of moving parts, but it can be simplified. And that's what my team really focuses on. So appreciate you all tuning in, and we will see you next week.
thanks, Dallin. Have a great day, everyone.
Thanks, guys.
Thanks,
Take care.
Alan.
Bye-bye.